Energy Transition Now with David Linden.
Hello everyone, I'm your host, David Linden, the Head of Energy Transition for the Westwood Global Energy Group, and you're listening to Energy Transition Now, where we discuss what the transition really means for the oil and gas and the broader energy industry. In today's podcast, we'll be focusing on BP, an international oil company whose strategy is all about transformation to an international energy company. And I'm really pleased to have Dominic Emery, the Chief of Staff to BP CEO, with me today to speak about that transformation. Dominic is a geology graduate and has worked for BP since 1986. He has had several positions in BP's E&P division in Asia, the Middle East, and the UK North Sea. He has also led gas and power business development in Europe and has run power and utility assets at BP's industrial sites. Dominic then joined BP's alternative energy arm in 2007 and ran emerging business and corporate ventures in 2012. Then in 2013, he moved to the role of VP Group Strategic Planning, where he was responsible for strategy development, long-term planning and policy. And he was appointed to his current role as Chief of Staff in February last year. In addition to this, Dominic was the founding CEO of OGCI Climate Investments, and he's also on the board of the EITI, so that was just the Extractive Industries Transparency Initiative. Dominic, that's quite a background. Thanks for coming onto the podcast.
David, thank you very much indeed. A real pleasure to be here. And when you said I started at BP in 1986, it does make me feel rather old. But anyway, I've been through many changes over the course of my career in BP, but I have to say this kind of current transition feels like the most kind of monumental of all. So look forward to the conversation with you.
Perfect. Absolutely. I'm looking forward to it too. I think if you've had a chance to listen to some of the other podcasts in this series, normally what I would do is I'd ask you, what's your business doing, which direction you're taking, etc. But I think this time I'd like to do something slightly different to start off with. And I guess the reason behind that is that BP also publishes its own statistical review, its own view of the energy world, both past and future in terms of scenarios. And you most recently published your latest statistical review, I think now in its 70th year, last week, at least at time of recording. And because 2020 was ultimately labelled, I guess, as a year of real change and pivotal in many senses, I think it's useful just to unpack that a little bit. So Dominic, maybe just to get us started, can you maybe talk us through what you see some of the key energy trends or highlights that you saw coming through in 2020?
Yeah, absolutely. And credit to Spencer Dale, our chief economist and team for developing the stats review, as you say, kind of 70 years and counting. And as you rightly say, 2020 was an extraordinary kind of dramatic and tragic year, with the pandemic having a dramatic impact on energy markets, with both primary energy and carbon emissions both falling at their fastest rates since the Second World War. On the other side of the equation, we also saw renewable energy continuing to grow, particularly with solar power recording its largest ever increase. So just a few kind of stats that I think are worth kind of bearing in mind. Firstly, primary energy consumption fell by 4.5% in 2020, which is the largest decline since 1945. And actually, most of that drop in energy consumption was driven by oil, which contributed probably about 3/4 of the net decline. Although we also saw a decline in natural gas and coal. I think the other big point is that carbon emissions from energy use fell by 6.3%. To their lowest levels since 2011. And again, as with primary energy, this is the largest decline since the end of the Second World War. So I think they're the two kind of big numbers. And just dwelling on that 6.3% fall in carbon emissions, given the dramatic change that we saw in 2020 in terms of the world coming, if not to a complete, then to a considerable kind of standstill, I think that gives us pause to think about the emissions reductions that will be required to meet the Paris goals. roughly will require emissions of that order of magnitude every year between now and 2050 in order to approach net zero. So it's quite a kind of salutary lesson in that regard. I'll quickly just dwell on sort of renewables as well. So renewable energy, which includes biofuels, but it excludes hydro into the kind of BP's definition, rose by 9.7%, which was slower than the 10-year average, which has been about 13.4% per annum. But the increment in energy terms was similar to the increase that we've seen in the last 3 years. And as I mentioned earlier, solar rose by a record 1.3 exajoules, 20% growth, which was pretty dramatic. So if you like, we are seeing the kind of the beginnings of the kind of the transition. But I think another point that Spencer and team did make when they went through the stats review was that we are seeing a kind of a dramatic uptick in energy use in 2021, unsurprisingly, as we start to come out of the pandemic, and commensurate with that, we're seeing emissions rising as well. So we're certainly not on track to see that steady and dramatic fall in emissions that we saw in 2020.
Okay, so there's a lot of good stats in there, and we could almost unpack each one of these. But I guess the overall theme here is interesting because, as you say, it's we were forced into a situation where this would happen, and it almost sounds like we'd have to be forced into it every year for us to reach the Paris goals. And what we see now is that the rise is back up in emissions in 2021. So is this a temporary blip? Is this a nice, okay, this is what we could achieve? Or is this a structural change? So there might be, similar to the oil price, an uptick in the short term, but actually structurally things have changed. And so this is a turning point as such for us to get towards Paris.
I think it will be seen as a kind of a pivot point because we are seeing significant growth in the renewable energy technologies globally as well. So it has acted as a kind of spur, but we will simply not see the kind of reductions that we saw last year. And I think in large part last year was a matter of kind of dramatic kind of demand destruction for obvious reasons, particularly for liquid fuels, with people not traveling around, either light duty transport, either on-road heavy duty, and of course airlines. They were the sectors which saw the most kind of dramatic decline in liquid fuel consumption, which is why oil, if you like, took a disproportionate share of that reduction. But we are seeing that demand coming back very strongly, and that's reflected both in the demand side in the equation, particularly for kind of on-road, less so for kind of airlines. That's a much kind of slower build back up again. So I think the other challenge is that as we come out of the pandemic, there is if you like, a tendency for people to want to use their own form of transport rather than necessarily using public transport. So that has a sort of countervailing effect. Now, having said all of that, I do think alongside the kind of pandemic challenges, we also saw a number of countries making some pretty dramatic moves towards net zero, particularly China's announcement around 2060, and also the US rejoining the Paris Accord. So I think we're now seeing more governments putting the kind of net zero very much at the heart of their transition agenda. That's a really good thing. And then I think secondarily, and Spencer and the team do talk about this in the stats review report, we're now seeing many thousands of companies committing to net zero as well. So I think we are seeing the signs of a kind of real change. We won't see the same decline in emissions as we saw between 2019 and 2020 as a result of the pandemic for reasons I think that are pretty clear.
Absolutely. No, very interesting. I mean, I think you can see that the commitments that governments and companies have made are clearly, probably the clearest signal of change that has come out of 2020. I certainly can see that. The difficulty, of course, though, is turning those commitments into reality. And BP has its own forecasts, its own scenarios as to how it thinks some of this can be achieved. So how do you achieve net zero? Can you maybe just talk us through a little bit around your own scenarios, and specifically, I guess, net zero scenario, and how is that maybe different to some of the other scenarios out there that have been published, maybe some of the more recent ones, such as the one from the IEA, and how they compare?
Yes, certainly. And the stats review is kind of, if you like, backward looking, that has some kind of sense of near term kind of momentum. But the energy outlook that we publish every year now, we've done that now for some years. I would say a few years ago, we tended to produce just one view of the world, which was our kind of most likely view. But then in the last few years, Spencer and team have been publishing more in the way of different scenarios. And so what we publish is a scenario that is more, if you like, a kind of a business as usual scenario than what we call a rapid transition, which is more akin to well below 2 degrees. And then this year we published our net zero scenario. It is actually strikingly similar to the IEA's kind of net zero emissions scenario. I think a couple of things that I kind of would point out is that the requirement for kind of large scale up electrification, wind and solar power, etc., alongside the need for investments in energy infrastructure, the role of hydrogen and CCS, they are kind of very similar between the different scenarios. I think if you look at the investment, for example, required in oil and gas between our scenario and that of the IEA, they are actually quite similar. Both of them, roughly, they're anticipating investment in oil and gas of around 170 to 200 billion per year. So again, quite similar levels of investment kind of required to maintain oil and gas, albeit on a kind of declining trend as we head towards mid-century. And again, I think we also identified that OPEC's share of production, because of course it will be the lowest cost production that will kind of be the last oil that kind of remains in the system, will increase to roughly 50% from about 35% today. So there are some quite similar features of the two outlooks. We think it's important to have these range of different scenarios, because what we want to enable is our strategy to be robust to a range of scenarios rather than pin it on one in particular. But in fact, the way we're configuring our strategy and our plans is very much to kind of sit within the Paris goals, sort of consistent with Paris, well below 2 degrees, with an ambition towards kind of net zero by 2050.
Absolutely. You know, what I found difficult, I think, is an external looking at all the different scenarios that are available in the market, and the IPCC in itself has, I'm trying to remember, 90 plus or so of them themselves when they look at their own 1.5 view. The complexity and the range of drivers and outcomes is hugely wide ranging, and it's interesting how you say there's quite a few similarities between the BP and the IEA one, and I couldn't agree more. It was quite fascinating to see what oil demand actually looked like in 2050. It was pretty much the same in that sense. The one thing I did notice though was there was quite a bit of difference in both overall energy demand and in gas demand as well. So there was more gas demand, I think, in the BP scenario, and more overall energy demand. Now, I see that as maybe as a way to say, actually, that's a bit more of a reality check around that the world is going to demand more energy going forward. And I think the IEA relies a lot more on energy efficiency. How do you see that in terms of near-term, mid-term, and longer-term energy demand playing out? Are we going to have a scenario where everyone's going to have to reduce their intake, or is this something which we are going to have to see growing, because ultimately, the world is still going to have to grow, and GDP, requires energy at the end of the day?
It does, and the long-term trends are clearly that the amount of kind of GDP for any given unit of energy is kind of growing. So for any unit of energy you put in, kind of GDP grows a little bit more, or vice versa. So you don't have to put so much energy in. And of course, the carbon emissions intensity of that unit growth of GDP is also coming down. On average, that's a good thing. I think you're quite right. The IEA have been pretty consistent in their expectations for energy efficiency. I think the reality is that the kind of the big energy efficiency opportunities, particularly at the kind of the if you like, the kind of the retail consumer level, haven't materialized perhaps in the way we might have expected. And that then kind of, if you like, creates an onus on the supply side to decarbonize more rapidly. So if you take the kind of the pandemic year as an example of where we'd seen kind of massive demand destruction, so more than 6% emissions reductions, we simply can't expect that demand side reduction to kind of happen year on year on year and kind of, if you like, put it all on the demand side and energy efficiency. So in a sense, it's a lesson to us on the supply side, which is to say we have to decarbonize the supply side actually really, really rapidly. Your point on gas is a good one. We've been consistently, I think, more bullish about sort of gas. In part because we do see the opportunity for gas to be decarbonised kind of more readily through kind of carbon capture and storage post combustion, or potentially through the creation of hydrogen and blue hydrogen into the kind of sort of medium long term, again alongside green hydrogen, which will be very competitive as well. So I think they're the two primary reasons for that kind of for those differences. I mean, I think we all hope that energy efficiency will be a kind of a very big deal, both at the kind of retail level and at the kind of industrial and the industrial and business level. But there's some kind of hard yards to go at that yet.
Absolutely. No, thank you. I mean, that's an interesting perspective there, actually, on the supply versus demand side that people forget as to where does the onus lie? How can you actually make change happen? And you know, who's responsible ultimately for it? So it's a very good thought there.
If I could just say, I think it actually it lies across the value chains. So I mean, inevitably, we all have to play our part across these value chains. And one of the ideas that's kind of, I think, gathering quite big sort of currency, particularly through the World Economic Forum and their Mission Possible partnerships, is to develop these sectoral decarbonisation opportunities, be it for aviation, be it for marine, be it for on-road heavy duty, the so-called hard to abate sectors. And that then includes kind of stationary sources, so kind of big industrial kind of emitters such as steel and cement. So I think creating these sort of handshakes up and down value chains will be enormously important as we seek to decarbonize these tougher to abate sectors.
Okay. Very interesting. I'm sure we'll come back to that point in a minute, because I think what I'd like to turn to now is to talk a little bit more about BP's actual strategy, because of course 2020 was a year of change for the global economy and global energy system as such, but it was also a year of change for BP as well. You know, looking to turn to a very different energy company in the next decade. Would it maybe be possible for you just to start off with, you know, explaining who is BP now and what does it stand for?
Yeah. So this was a kind of a series of, in 2020, a series of quite significant events that we wanted to kind of lay out to, let's say, our kind of wider stakeholders and to the investor community. So clearly it started with Bernard taking over as chief executive at the very beginning of February. And really prior to that, spending time with both our broader stakeholder groups, but also our kind of critics. So people who are going to say, well, you guys are simply not moving fast enough. Let's really understand where the kind of the deep challenges are coming from vis-a-vis what our intentions were. So if you like, a kind of quite a deep listening process with those who would seek for us to go faster and those who would criticize us more kind of dramatically. So that was quite important. I think the second thing was, and then in listening to those critics, also understanding the opportunity of the energy transition. So seeing this as essentially an optimistic exercise. And if you look at be they IEA numbers, be the IRENA numbers, others, the amount of investment that's going to be required to replumb and rewire the world's energy system is phenomenal. So between now and 2050, it's of the order of $100 trillion. So you're looking 30 years, you're looking at 3 trillion a year. So if you're an investor into that opportunity, you're saying, well, bring it on. This is wonderful. So you take an optimistic perspective that this transition creates business opportunities and decarbonisation opportunities hand in hand. So I think understanding the kind of the criticism and understanding the opportunity and taking an optimistic disposition towards the opportunity was kind of, these are two big kind of starting points. I think the second thing was really about trying to define the kind of the purpose of the organization. And so we spent a lot of time with our executive, our board, and various kind of various focus groups, trying to get a clearer and sharper purpose laid out for the company. And so we did that, and that was reimagining energy for people and planet. And that's a big deal. And it sounds quite sort of grand, but then that allowed us to kind of layer up our ambition around kind of net zero by 2050 or sooner, and then a series of aims that we laid out again back in February last year. So optimistic disposition, kind of a new sense of purpose, and then a net zero ambition supported by aims to decarbonize the company and also to support the world decarbonising. Then that's, if you like, set out a kind of a stall for us, and then we committed to come back in August, September with a revised and kind of sharper definition of the kind of the strategy, the new organisation, etc., which we did. And of course, the kind of within a few weeks of laying that stall out in February, the pandemic kind of became the big and challenging and difficult kind of story for everybody. Which, and as we know, oil prices kind of plummeted to levels that we hadn't seen kind of ever, negative for a couple of days. And we had to kind of take a deep breath and determine, do we continue or do we kind of pause? But we felt that we wanted to kind of continue with a kind of transformation exercise. And then in August, we came back with a, probably slightly earlier than we were planning, we were going to come back with a more deeper kind of perspective on our strategy in September. In August, we came back with a kind of a high-level strategy. We came back with a new financial framework that was very important. We also halved our dividend in the kind of the circumstances of the pandemic. We felt that it was going to be very challenging to continue with a dividend payout that was as it was. And we recreated a kind of a new financial framework for investors. So that was the kind of the big deal in August. And at that time, we also started using, as you used at the start of the podcast, the transition from international oil company to integrated energy company. So that's become the kind of an important kind of mantra for the company. Which then allows us to start to talk about the way we've now organized BP into our business groups, into our integrators, and into our enablers, along three big strategic themes, one on low carbon electricity and energy, one on convenience and mobility, and then one on resilient and focused hydrocarbons. So they're the big strategic themes, and then cross-cutting those, integrating energy systems, and so that is, if you like, physical integration, virtual financial integration, partnering with countries, cities, and industries, and we've created a new kind of business team called Region Citizen Solutions to do that, and a lot of that underpinned by digital innovation, both at the level of efficiency internally and the level of customer innovation. And then finally, the big wrap around that was essentially the kind of the purpose and a new set of sustainability aims, which was the, if you like, the final piece in the puzzle that we laid out back in April this year. So that's the kind of the essence of it. That was the motivation, a series of kind of set piece presentations on purpose, aims, and ambitions, then on kind of strategy, financial framework. And then, to be frank with you, subsequent to that, it's all been about strategic delivery, achieving strategic milestones to demonstrate progress, and also kind of maintaining kind of performance as we kind of make this transition.
Super interesting. Thanks. That's a good summary, actually, of a lot of things that have happened in the space of, well, just a year, I guess, almost slightly more. What's interesting, of course, we have a bit of hindsight now. We can sort of look back what's happened over the last year, and sort of having listened to you now and listened to how Bernard Looney's talked about the strategy, etc. He's often used words like de-risking BP or balancing or words like that. Um, is it fair in that sense, as that's what you're doing here as well? You're sure you're seeing there's an opportunity, and it is an optimistic scenario, but it's also about de-risking the business, and trying to set it up for the future, because ultimately, the belief is that there is a decline in the core, and opportunity elsewhere. So you need to de-risk that effectively.
That's exactly right. So I think the two things come as a kind of a package: the opportunity in the new and the de-risking of the core. We believe deeply the world is serious about the Paris goals, and therefore emissions becomes a risk. And the extent to which you can reduce emissions over time in a kind of a measured and systematic way means that you can de-risk your portfolio over time. So having that kind of a more balanced portfolio, which is weighted towards low and zero carbon versus carbon intensive, is clearly the trajectory we want to be on.
Interesting. I think the one thing that stood out for a lot of people, so again, with hindsight, you look back and I think you were looking at 50% of capex is related to transition by 2030. You talk about CCS and hydrogen. I think when the strategy initially came out, it looked quite new and fresh. And actually, if you look at what everyone else has done, it's kind of similar, if different. They've all chosen their own sort of specialisms, or sort of created their own targets. But in essence, it's similar-ish in one way or another. But there are a few nuances or differences that I think I'd like to just pick up on. And I guess the initial sort of clearest one is that 40% reduction in oil and gas production that you're looking to achieve in the next decade. Can you maybe just talk us through the rationale for that, and how you justify that relative to the need to invest elsewhere? So I know you were quite clear as a business to set out the financial justification of doing this. And I say this again just with hindsight as well, of course, because a number of your competitors in this space, or partners, of course, you're also partnering a lot with them, they're saying, no, actually our portfolio is increasing in production in the next few years. So, we don't believe that's necessary. Well, of course you do. So it'd be interesting just to hear your rationale for that.
Yes, I think there's probably two kind of components to that. One is about wanting to have a kind of a resilient and focused hydrocarbon portfolio. And so what we're seeking to do is continue to kind of high grade the portfolio. And there are a couple of things that we did. One, which was that we, if you like, raised the bar in terms of kind of returns and quality expectations from those resilient and focused hydrocarbons. So for kind of new projects, it's going to be tougher. And then secondly, we made it tougher still because we reduced, as you may recall, last year, we changed our kind of long dated kind of price assumptions for investments. And of course, we review these on an annual basis. We are seeing the oil price move in very different ways, clearly at the moment. But I think it's fair to say that as a result of that, we made it even more difficult for those resilient and focused hydrocarbons to chin the bar in terms of returns because of we reduced price expectations. And that also resulted in some substantial kind of write-downs, again, that the market saw last year. So that means there are certain projects that we will no longer do that we had anticipated we would do because of those write-downs and because of, if you like, raising the bar in terms of the quality of investment expectations. So we're really trying to kind of drive quality through that portfolio. And that means that we still anticipate producing oil and gas, for decades to come, but there will be less of it, and the quality will be higher. So that's the kind of proposition that we've kind of put out there. I think that the second thing is we've chosen a particular kind of metric, which is for those emissions, which is an absolute emissions metric. And really, that's fundamentally based on the fact that the carbon budget is finite. It is based around absolute emissions of CO2 to atmosphere, not around intensity. So we can track intensity as well, but our kind of preference was to set a series of fairly kind of stringent, certainly for operational emissions and for the equity emissions from the combustion of our production, be it gas or be it oil, to actually set absolute kind of some absolute targets and also some absolute aims because of the finite nature of the carbon budget. And bringing new carbon, if you like, into the atmosphere from the subsurface, we felt was probably, if you like, not in the kind of the spirit of the of getting to Paris. So they're the kind of fundamental reasons why we've chosen that particular target. I think. And so there's sort of emissions and, if you like, strategy related, but there's also the kind of financial component you described earlier, the switching of capital investment from those kind of capital intensive hydrocarbon investments into also capital intensive kind of renewable energy investments, which is what that's how we're switching our capital out at the moment.
Okay. Yeah, no, that makes a lot of sense. I mean, the thing I'd just like to sort of touch on there as a follow-up, though, is around those emissions and the concept of de-risking. We've talked mostly about your equity, and this is where I think, unless you want to spend a whole podcast talking about emissions, we'll keep it to a couple of questions, because I think it's a really big area which is very difficult for a lot of people to understand, because you've talked about absolute and you've talked about intensity, then we talked about equity, and then we talked about other volumes that folks trade or sell on behalf of somebody else, et cetera, et cetera. So it becomes quite complicated, and you almost need to read the detail behind all of the different calculations to make sure you fully understand it. But I think there's 2 points around emissions I just want to understand. I think the first one is, clearly, BP was one of the first companies, if not the first, from the super majors to include Scope 3 in its target. But that, of course, only includes what we call the equity share side of things, and excludes Rosneft as well, as such, because and I guess the question most naturally is why is it like that, rather than saying it includes everything? It'd be interesting to hear your response to that, please.
Yeah, and so our kind of preference was to include, if not emissions we had control over, but emissions where we could influence. So I think the influence point is very important. I think with Rosneft, again, we have we're less than 20% share, but nevertheless, we work very closely with our partner. And Rosneft's portfolio is actually, if one sort of stands back and looks at it from that kind of resilience and focused hydrocarbons perspective, the lifting costs are very low, amongst the lowest in the world. And actually, the greenhouse gas intensity is better than us. They're better than BP's, and actually better than many other international companies. And Rosneft does care very deeply about its kind of emissions, about its environmental performance, as does the kind of the Russian people. So I think in that respect, our continued participation alongside Rosneft, we can learn from each other and help to kind of drive this down. That's the rationale is kind of more around kind of partnership and influence, as opposed to having a greater degree of control. On the other, on the Scope 3 emissions as a result of kind of customer products. Now that's a very different and much more kind of challenging matter, because the Scope 3 emissions from customers is much greater than the Scope 3 emissions from the combustion of our own products. So we're talking about 350 odd million tons from the combustion of our production versus over a gigaton from customers. And of course, we're looking to reduce the intensity of that by kind of 50% by 2050. And as you rightly say, after we published our kind of what we thought were some big bold aims back in and ambitions back in early last year, a lot of our kind of European peers are now very much on the kind of same track or kind of ahead in terms of ambition. And we have to understand that. Nobody's laid out that 40% reduction of production. So that's a specific thing for ourselves, because it becomes more of a transition play from carbon intensive to low carbon. whereas a number of competitors, they're seeking to kind of reduce intensity rather than kind of absolute at the kind of production level. So there are some important, I think they kind of, one might say nuances, but there are some quite fundamental differences in strategic approaches here. But nevertheless, as soon as there is no doubt that competitive positioning over emissions and emissions pathways is precisely that. It's a sort of competitive thing that will either attract investors in or repel investors. So it's a very big deal. And of course, we'll keep our ambitions and our aims around emissions, which then translates straight back through to strategy under review, so that we can be seen to be progressing commensurate with the Paris goals.
Interesting. Yeah, no, thank you. And you're absolutely right. It's everyone's got a choice of how to present their own strategy, how to reduce their own emissions, and then they have to get stakeholder, not just investor, I guess, but stakeholder buy-in with that. And are they believable, acceptable, etc., whichever word you wish to choose, and depending on the stakeholder you are, and you go from there. So all these things are developed in combination with that in mind. Maybe another area that, and this is not just exclusive to BP, but also I think the industry as a whole as well. A lot of folks initially, when all this kicked off 2 years ago, even before then, a lot of the discussion was around why would an industry go from high return, although of course high risk, oil and gas production, exploration and production and refining, is the whole value chain we've got to consider here, to doing something which ultimately is, a solar panel in a field, let's just say, as an alternative, which of course is a much lower risk opportunity, but then also naturally a lower return opportunity as well. Now, that has gone on, and people have given different reasons as to why that is. It might be good just to hear a little bit from yourself, Dominic, as to why BP is doing that. And you do a lot through Lightsource, for example, as well. And it's the opportunity there. But I think in particular, the question that people who are longer term in the industry and newer are saying at the moment, look, my returns are maybe not quite what I expected. There's a few sort of headwinds to the industry as subsidies are reduced, et cetera, et cetera. Are some of these returns at risk, or is there something that someone like a BP has that can help to secure some of these returns? So I'm asking you two questions, unfortunately, in one go, Dominic, so apologies.
No problem. So if I pass the two questions apart, and let's perhaps just dwell on the kind of returns aspect. And one is corporate returns, total shareholder returns. And if you look at that over the last kind of several years, it's pretty clear that those who are investing in kind of renewables and, if you like, kind of growth stocks have seen far better kind of total shareholder returns, even if we include the kind of the dividend that materializes from oil and gas companies. So corporate returns have been quite disappointing in the oil and gas sector. So but of course that's very different to kind of project returns, which I think is what you're getting at, which is clearly historic returns on a kind of project by project basis in some cases have been extremely high. And there was a period of time, there's a sort of very sweet spot for the oil and gas industry when we were actually seeing corporate returns on capital in excess of 20%. Now, I think those days are kind of rather behind us, and they were kind of super normal returns. But having said that, so project by project returns, will still be kind of higher in oil and gas in general, but they are associated with cash flow risk and variable cash flows associated with oil price movements. And we're seeing some dramatic oil price swings just in the last year or so. So the kind of stability of kind of returns is challenging. With the pivot into renewables and alternatives, the cash flow returns are much more kind of stable. The IRRs will tend to be lower. They'll tend to be kind of high single digit into kind of low double digit. But what we've said, and this comes back to that kind of basic point around transitioning from international oil company to integrated energy company, we believe that what we can bring to those kind of projects is the operational and project expertise, say offshore wind, that we've learned in offshore oil and gas, the integration opportunities. So take, for example, offshore wind and hydrogen. So these are the kind of things that we believe as big energy players over kind of decades and decades, we think we can do very well. And then on top of that, sort of balance sheet strength, structured financing that we can bring to actually improve the returns. And then depending on how one wants to kind of hold an asset, if you want to hold it for the long term, you get long-term kind of stable cash flows. Or of course, there's a kind of farm down and sell down options as well. And we've seen that, pretty, happening quite successfully for a number of our competitors. And of course, that's very much, you mentioned Lightsource BP, that tends to be the kind of Lightsource BP business model. So we do recognize we may be swapping out, let's say, supernormal kind of returns on oil and gas projects that maybe for an instant when the oil price is very high look fantastic, but we do like the kind of a more kind of stable, if you like, bulwark of returns from renewable investments that we would anticipate over the coming decades. So it's basically it's a trade-off of sort of quality of cash flow versus returns.
Interesting. And is it also fair to say that it's also, if I go back to sort of the original discussion we had around de-risking a business a little bit, is it part of that as well? So, you're reducing part of the pie, which is riskier, and replacing it with something a little less risky, a little bit more certain, as you say, on the cash flow side of things, but therefore also de-risking the business a bit.
No, I think it's fair to say it is exactly that. It will come. So you're de-risking the volatility of cash flows point forward. The one other thing I would say is that the opportunity for integration is something that obviously is quite nascent, but we believe very kind of deeply in that and what that may bring to bear. So we think that can add sort of percentage points to returns. And indeed, some of the new businesses like hydrogen and CCS. I mean, CCS kind of the reverse of oil and gas exploration. It still has quite a lot of challenging hair on it in terms of kind of reservoir risk, as many petroleum engineers, reservoir engineers, geologists listening to this will know. So we wouldn't expect to get, if you like, kind of modest rates of returns for CCS. We would expect that to be reflective of the risk, particularly inherent in the kind of the subsurface and the engineering that would go into a big CCS project.
Super. Thanks, Dominic. I mean, that's very interesting indeed. And I agree that the integration side is interesting, and I guess also it requires you to partner with a lot of people to make that happen. And I've seen BP's done that at an early stage through your listening exercises, but also as you get into different projects itself. But I think despite all of that, despite all the questions you're getting around the structure, the changes you've made, it's only been a year and a bit, etc. There is still a sense, and that different, whether it's financial groups or NGOs or others, they continue to say, well, that's all very nice, but can you please go faster, harder, etc., etc. Do you get that sense that there's pressure to do more, or this is now, you've done a lot, let's just stick to the plan and see how it goes?
It's a great question, and of course there will be pressure to do more, and we will kind of continue to determine how much faster we would want to go, subject to that kind of pressure. But I think there's one really fundamental point here, which is around the nature of the transition, the nature of our company and many others in the transition, and the nature of kind of investors. Fundamentally, we need to bring emissions down. So we would say it's important for investors to invest in companies that are chasing emissions down. Energy represents something like 70% of emissions. And so investing in companies that are making kind of real commitments and setting kind of targets to that transition, sort of so-called greening companies that are seeking to move from, if you like, kind of brown to green, is really important. There are lots of brilliant kind of solar and pure play wind companies that are out there that are kind of already green and get kind of big scores on the ESG metrics, such like, and that's great. But the reality is we won't solve the emissions challenge. We won't get to the Paris goals unless we support those companies that are committing to make the transition, the so-called greening companies. So I think that's an important kind of thesis that we want to kind of get out there, that we're kind of sharing with our investors and other stakeholders. It's going to support greening companies, kind of support making it happen, because without that, we simply won't reach the Paris goals. So I think I'll probably end on that. There will be pressures to do more, but we also see this as a bigger ecosystem of companies, investors, and wider stakeholders driving that greening agenda for companies that are prepared and committed to make the transition.
Wonderful. Okay. No, thank you. No, I think that's a really interesting point. And sometimes people swing from one side to the other, and actually it's a bit of both. And going through the process, as you say, it is a transition. But thank you. Really appreciate you taking us through that. First of all, looking through 2020 and the year of change we've had there, both in the energy industry and also for BP, and also walking us through your strategy and ultimately what it means, and just looking under the hood a little bit and some of the features that we should pay attention to. So it's been a really good discussion. Thank you very much.
My pleasure. Thanks a lot, David.
Perfect. And thanks everyone else for listening as well. Hope you enjoyed it. Please make sure you subscribe, give us a good rating, and share with your friends. And talk to you next time. So that's it for the first series of Energy Transition Now podcasts. A big thank you to all our guests. And don't forget, you can let us know your thoughts via the Energy Transition Survey, available on the Westwood Energy Transition website. We'll be back after the summer, and of course you can follow Westwood on social media or sign up for our ET newsletters to keep abreast of the latest insights and on the Series 2 topics and guest lists.